Stocks are red hot right now as the industry goes rapidly through the legalization of recreational marijuana, and investors have been pouring money into these stocks recently, and this shows in their growth. Three of the bigger companies in this expanding industry are ticker WEED on the Toronto Stock Exchange and CGC in the New York Stock Exchange, and that is Canopy Growth Corporation. The next is Aurora, which is only on the Toronto Stock Exchange with stock ticker ACB. And finally you have Aphria, which is on the Toronto Stock Exchange again, which is APH. These are all Canadian companies that produce hundreds of thousands of kilograms of cannabis each and every year, and with groups pushing for legalization in other Western countries across Europe, there are plenty of potential growth market opportunities for these companies. And a report by Grandview Research seems to believe the same thing, with them predicting sales for medical and recreational cannabis can reach potentially 146.4 billion by the year 2025. I want to first have a look at the key figures for these companies. Generally, stocks are measured with PE ratios, price to expense ratios, but these are up and coming companies. They're generally spending much more than they take in income on their growth, so they do not have PE ratios currently. And as you can see here, I've included the graphs for these companies, and these are all based over a year's period for each of the three companies. And to generalize, all three fell towards the end of 2018 and are still trading at a discount from their peak earlier in that year. However, Canopy Growth Corporation has rebounded the quickest, as you can see here. And the other two are still trading at quite a fair discount. So let's first look at the market caps for these companies. As you can see, it shows a fairly sizable difference between the sizes of these companies, with Canopy being by far the largest with a market cap of almost $22 billion, Canadian that is. This company is listed on the New York Stock Exchange, however, which the other companies are not. So that makes it obviously more accessible for investors outside of Canada, a lot less work for US investors. The next is Aurora, which has a market cap of almost $10 billion, which is a fairly sizable market cap. And then Aphria, which is $3 billion Canadian again, which is obviously much smaller than Canopy. These companies all operate with market caps in the billions, as you can see. However, this does not make them large companies by any means. In fact, they are fairly small market cap companies, and I realize that does sound crazy when talking about companies that are worth billions of dollars. But so if we have a look at their price to book ratio, price to book ratios compare companies' market value to their book value, and book values are simply a way of representing the company's net assets, which means if the company is completely liquidated if the company completely liquidates all of its assets and pays off debt, the book value would be the company's remaining value of assets after debt has been paid off. Value investors love price to book ratios and consider any value under 1 is a fantastic value. But if a company has strong growth prospects, a value under 3 is still generally considered a very good bet by value investors. However, as you can see, Canopy has an extremely high price to book ratio, almost 9, and this does suggest that they are currently quite overvalued compared to their assets, especially when compared to a price to book ratio of 1.8 for Aphria and 2.1 for Aurora. This is again demonstrated in the company's price to sales ratio, which you can see follows the same pattern as Canopy having the by far the largest at 136.36, followed then by Aurora again at 73.05, and finally Aphria by 46.69. And this goes along with the theme that Canopy Growth may possibly be a overvalued stock right now, especially compared to the other two players in the same sector. So if we have a look at the debt to equity ratio, they do follow a different pattern to the price to book and price to sales ratio that we saw above. Aurora this time has the highest at 10.64%, followed by Aphria at 2.37%, and Canopy has an astonishingly low 0.59%. These are all represent very healthy financial companies with very little to worry about in the way of debt. So in my opinion, investors can feel completely comfortable with the level of corporate debt these companies are taking on. These are extremely reasonable levels of debt, especially for a growing company like these are, rapidly expanding and acquiring other companies. And we'll learn more about how Aurora has acquired so many companies without taking on massive amounts of debt a little bit later on. So this is everything you need to know about Aurora, and they have sales and operations in 22 countries across 5 different continents. They currently operate 11 facilities, including Aurora Sky, which is the world's largest and most advanced cannabis facility. which has only just been built. They have over 500,000 kilograms per year of production capacity, which is all GMP certified, meaning that they can be sold in the EU. And this is a huge plus point for Aurora. They have 38,000 kilograms recreational supply agreements, and that's not including Ontario, and Ontario is 40% of the Canadian population. So that 38,000 kilograms that they have currently guaranteed minimum per year is subject to increase. 27% of their revenue is from Europe, thanks to owning of Pedanios, which is the largest weed distributor in Europe. It's a German company. And the European market is predicted by analysts to be 10 times the size of the Canadian market. And this is why it's so important as well that their production facilities are all GMP certified, which means if the Canadian market is to be that much of a smaller market compared to the European market, which would make sense as they have many multiples times the population size of Canada, if they do manage to sell and if it is legalized recreationally in Europe, then this could give Aurora a massive advantage in terms of reaching that revenue growth. And finally, they have liquor stores in North America they have partnered with, and they are planning to sell weed through their physical locations, which gives them great access to physical and online markets. They are, however, causing share dilution, and this is what I was talking about earlier about rapid expansion without taking on massive debt. And this is how they're doing it. They are causing share dilution by offering shares in the company in exchange for purchasing other companies, and this does decrease the market value of the shares. So they are causing investors to lose money currently. However, this should pay off long term if the acquisitions they're making are solid acquisitions. So I don't think investors should be too worried about that if you have faith in the directors and the leadership team at Aurora. So next we'll have a look at Canopy Growth Company, and they have operations in 12 countries and across 5 continents, which is 10 less countries than Aurora, which obviously means they're less diversified in their revenue streams. However, 12 countries is still fairly sizable for a small and growing company. They do have excellent access, however, into the Canadian recreational market with 10 supply agreements with 70,000 plus kilograms of minimum supply, excluding Ontario, which again is 40% of the Canadian population. And this is one of the best supply agreements. This is probably the best supply agreement between the 3 companies that we're going to look at. And 70,000 minimum is almost double that of Aurora's current minimum supply agreement. They also have physical and online stores in multiple provinces. They're a leader in Canadian medical cannabis with over 85,000 patients currently and growing rapidly. They are also invested into other ventures, such as they are currently making a calorie-free, long shelf-life cannabis-based beverage through a partnership with Constellation Brands, which is a potential $500 billion market disruption value, which this could be huge if they can pull this off and get this drink marketed properly and through all of the strict approval processes. They are also looking into sleep aid research, which is a potential $100 billion industry. And they have recently expanded into Latin America with a 4.5 million square foot facility, which could give them access to a lucrative Latin American market, which some argue could be as big as Europe in the future. Only 12% of their sales come from Europe compared to 27% of Aurora, which obviously does give them less access to that lucrative European market. And they do have 500,000 kilograms of production capacity upon completion of their sites throughout 2019. However, only 500,000 square feet of this is GMP certified to supply to the European Union, whereas Aurora has 5 million square feet, which is GMP certified to supply to the EU. And this would again show in their sales, which for Canopy is only 12% come from Europe and 27% come from Europe for Aurora. Finally, we need to take a look at Aphria. So they have supply agreements in place with all provinces in Canada, which is fantastic, enabling access to 99.8% of all Canadians. That's massive. For a company this small, they have the supply agreements in place, so now it's simply that marketing, that selling the product, but to have access to that many Canadians is absolutely amazing. They also have recently partnered with the largest North American wine and spirits distributor, which is called Southern Glazer. I'm not sure how many of you are familiar with that, but it has operations all throughout Canada, 44 states in the US, and allows access to the Caribbean. And this is another huge factor for Aphria, as they're laying the groundwork for this distribution system that they're creating, which they're first ensuring they have access to the clients and the customers before unleashing the product full scale, which I think is a great business model, and it allows for massive potential growth in the future. And they have also, speaking to this, they have also recently set up a supply agreement in place in Germany with a distributor giving access to over 13,000 pharmacies in Europe, which again speaks to that of what I was saying earlier about the distribution model they're putting in place. It's fantastic, giving access to many customers ready to unleash their full product and their full marketing later on. So another great thing about Aphria is they have a very low production cost of $1.30 compared to the competitors' average of $3.08. And this is massive. It means they get to keep more money and they have potentially more profit compared to the competitors. So when they produce a product, it only costs them $1.30 to produce the same product it costs another competitor to produce for $3.08. It's less than half is the cost for Aphria, which obviously leaves massive room for profit compared to the other companies that are going to be trying to sell the same thing at a competitive price, which means Aphria could potentially undercut its competitors and still be making a profit while the competitors could be hurting. They do have a much smaller production capacity of only 255,000 kilograms, which is about half of the production capacity of both Canopy and Aurora. However, they are expanding slower, and as I was talking earlier, they're setting the distribution model and making these partnerships before ramping up supply completely, which could be a good move, as I do see some of Aurora and Canopy's current supply going unused and their supply chain could be underutilized, their facilities. However, it has a gross margin of 63.6%, and this is compared to 41.28% for Canopy and 27.58% for Aurora. And this again speaks to that of the low production cost, which means they have a gross margin of 63.56%, which means they get to keep 63.6% of the price they receive for the product, in comparison to only 27.58% for Aurora. So Aurora keeps a much less percentage of the price they receive from the customer than Aphria does. And they've also acquired LATAM Holdings, which provides immediate access to Colombia, Jamaica, Argentina, and even potentially Brazil. Again, this is the distribution model I was talking about with Aphria. They have an excellent distribution system in place already, which should allow them to grow rapidly when they see fit, and when it becomes legalized. If they can now implement a system which increases their annual production and gets it GMP certified for Europe for those 13,000 pharmacies in Germany and across the EU, I do see potential massive growth for this company, as it is still the smallest company on this comparison with a market cap of under $3 billion. So in summary, Aurora and Canopy have by far the largest production capacity, of around 500,000 kilograms, which dwarfs Aphria at 255,000 kilograms. I think overall Aurora has 570,000 kilograms and Canopy has about 500,000, so Aurora is number one in this. However, it's not how much you can make, it's how much you can sell, which is the most important. But speaking to that, in the future, if these countries do legalize recreational as well as medical marijuana, there could be huge demand, and Aurora and Canopy would obviously be best set up for that massive demand that could be coming. I love Canopy's investments in other potential areas, such as the drinks, the sleeping tablets, or sleeping products, sorry, not just tablets. All of these other investments have potential for huge growth and to accelerate the company massively. Other companies are looking into this, such as Aphria. However, on their investors presentation, it does say to be announced, so they can't be included in this just yet. Whereas Canopy already have agreed a deal with Constellation to sort of manufacture and research these drinks. So I do think Canopy have the advantage in investments over the other two companies. However, Aurora does have the best access to Europe, with all of their production being certified for EU sale. Saying that though, Aphria again has made good deals for European distribution in the future, which could lead to them possibly drawing level if they can get their facilities GMP certified as well. But this one's still up in the air, and currently Aurora have the best figures for European distribution, with over a quarter of their current revenue coming from that marketplace. Another thing is Aurora is currently sacrificing short-term share price growth for long-term acquisitions, which could yield strong results in years to come, but obviously is at the cost of deteriorating current investors' investments essentially, whereas Canopy is growing much more steadily and slowly, as you can see with the much reduced debt to equity ratio of 0.59%, which is so small it's barely even worth talking about. Canopy do have the most deployable assets for expansion as well at $1 billion. Aurora has $500 million and Aphria has $314 million. And this is in line with their market caps. This is to be expected, I would say. This essentially shows exactly where the market caps are really, and where you'd expect, how much cash you'd expect these companies to have on their books considering the market cap. So, and Canopy does have the best access to Latin America. But again, Aphria are making deals which would allow them to enter the market, which could be, according to some people, could be as big as Europe. That's yet to be seen, as Europe obviously do have more expendable income currently than South American countries, which might mean that the price per gram they can charge in South America would be much less than they could charge in Europe. But that is yet to be seen, with the BRIC countries such as Brazil being in South America. This could be set to change, as there could possibly be a growing middle class in these countries with more expendable income. So that could be in Canopy's favour. So my personal pick is Aurora, which is a stock ticker symbol ACB on the Toronto Stock Exchange. I really like their rapid expansion and acquisitions, and I think they signal long-term intent. They are thinking long term, and even if that sacrifices the short term, I don't mind that. I do like a little bit of risk in stocks. I wouldn't put much more than 10-15% of my portfolio in Aurora, and I do think after this I'm waiting for earnings to come out, and then I will be deploying about 10% of my portfolio into Aurora, as I think they have a massive upside potential. I also love that they have the best access to the European market, which I think has the potential to be absolutely massive if regulated. I think there could be huge sales across Europe, and Aurora does currently have a facility in Denmark which is producing marijuana currently, and all of their marijuana grown is GMP certified, which again speaks to that European market access, which is massive, and operations in most countries around the world, which leads to less reliance on single markets such as the Canadian market, which, contrary to its physical size, Canada is a fairly small population country with half the population size of that of Germany. So again, speaks to that European market that could be absolutely massive. They currently have the largest growing capacity, so if any markets were to become legalized recreationally, Aurora would have the best facilities to provide that market with the highest quality cannabis in their fantastic new facilities they've built, such as Aurora Sky. They also have a much lower price to sales and price to book ratio than Canopy, which would suggest it's much less overvalued than Canopy is. I do think Canopy is slightly overvalued due to it being listed on the New York Stock Exchange, which means it is more accessible for US investors. A lot less work for the brokers to invest in. So that might have affected Canopy and their stock price. I'm currently, as I said earlier, I'm currently waiting for Q2 earnings to be released, and they're expected on the February the 11th of 2019. They recently released guidance below what was expected. However, I think this might have been a ploy to sort of release guidance that is lower than they expected initially, to then beat that guidance and have the positive headlines around Aurora saying that they beat their expectations on revenue. So I think I'm waiting for that, because If that comes in way below, then that'll be a massive game changer. However, I'm quite confident on Aurora, and I think after these earnings, if they come out well, I will be placing around 10% of my portfolio into Aurora. So subscribe, comment. Thank you very much for watching the video. It really helps if you like, comment, subscribe, all of those things. Leave any suggestions down below. It's really great to have you watch the video and make it this far. Thank you very much. Have a great day.